many of you guys on the call, we have saved clients lots and lots of money. The difference right now is that instead of just reducing people's income taxes, the CARES Act gives us the ability to be able to give somebody a refund back, a cash refund back. And at a chance right now when everybody's trying to get loans, trying to reduce their expenses, here's a way that you might be able to get cash back as well. So I'll cover 2 or 3 concepts that are covered in the CARES Act and then tell you how you can capture that. So this would apply to anyone that either owns a building or that someone that potentially owns a tenant where you're paying for improvements in a building. Either of these cases would apply, especially if you've recently done improvements on a building. There's a couple of additional things, but the biggest thing the CARES Act did was allow you to do what's called a net operating loss carryback. So what's a net operating loss? I have a year in my business where I had more expense than I had income. That's a loss. So a cost segregation helps create a depreciation loss. So what the CARES Act basically did is if you have a loss and you zero out your 2019 taxes, you have the ability to take that loss and carry it back to 2014. If you paid taxes in 2014, then that would reduce your taxes that you paid and you get a check back today from the IRS. Basically, if you create a loss, you go back to 2014, apply it forward to every year until you use that up and get a refund in the current tax cycle. It doesn't involve amending a return. There's just a simple form called a loss carryback form that you can use to capture that. So that's a great one. And one of the cool things about it is we have done cost segregation for 20 years, but the CARES Act allows us to create that loss to help building owners and tenants out right now. So what is cost segregation? You have a building or you paid for tenant improvements. They go on your depreciation schedule as a straight line item at 39 years or maybe 15 years. And let's say it's a building, you depreciate that $1 million building every year for 39 years. The IRS gives you 1/39 in depreciation expense to offset your income every year. With a cost seg study, you're able to accelerate parts of your property and identify 5, 7, and 15-year assets. That then creates a greater depreciation expense to offset your income. And the end result is normally lower income taxes in the current year. But with the CARES Act, what they allowed you to do is to go back and get a refund back for that. So that's the biggest thing and that they've done. So an action item, if you have paid for a building, if you own a building, or if you've paid for improvements, it's a great time to look at what's called a net operating loss and to see if a cost seg would potentially benefit you. The second thing is they changed a pretty big tax law called a qualified improvement property. And this very much pertains to those people that do leasehold improvements. When the Tax Cuts and Jobs Act came out, they did away with a restaurant improvement, a retail improvement, a leasehold improvement. They wanted to simplify that law and they called it all qualified improvement property. And they intended you to be able to use what's called bonus depreciation. So if you did any kind of improvement, they wanted you to be able to expense it in the first year with 100% bonus depreciation. Congress wrote the law improperly. With the CARES Act, they have corrected that. So if you did an improvement in the last quarter of 17 and 18 and 19, it typically is an interior improvement, and it can't be a structural item like an elevator, escalator, or the structural parts of the building. You potentially, that whole improvement would qualify for bonus depreciation. You could take it as an expense now. So let's say I'm a restaurant owner. I don't own the building, but I put $300,000 versus $300,000 of improvements in my space. And the law defined in the past was you had to depreciate that over 39 years. Now they defined it as a 15-year asset, and you can take it as a depreciation expense now. Again, if you're a restaurant owner, many of you guys have had to lay off your employees, and it's not just restaurant, just using that example. But you can take that loss now, apply it to an earlier year, and get a refund back now. So dentists, auto dealerships, you name it, any kind of commercial property, either if you own the building or you've paid for the improvements, you have the ability to create a loss and go back. And you can do that both with qualified improvement property as well as a loss carryback. And the source to be able to get that is a cost segregation study right now. So that's about it for me. I would kind of an action item if you were a building owner or you a small business owner that has paid for improvements. contact us through util auditors and get in touch. We can create a no-cost pre-analysis for you to see if you can benefit from that. And then with that analysis, we'll get on the horn with you and your tax preparer to see if that's something you can apply in your business. And the good news is that we specialize in all things surrounding the building, very knowledgeable. So we have a lot of CPAs that will contact us and say, can I do this? Can I do that? We will coach your tax preparer through whatever we need to get you the end result. And the end result, hopefully, is cash back in the form of a refund. And how much, if you had $1 million building, we're looking at anywhere from $100,000 to maybe even $200,000 in tax savings per building, per $1 million. So great number. If you're a building owner or you've paid for improvements, let us know, and we would be happy to run a pre-analysis as a starting point for you.